I want to start with a thought experiment. Imagine you have two choices. First, a coin minted by an empire, featuring the face of a powerful ruler. Second, a piece of yellow metal pulled from the depths of the earth. Something no government, no central bank, and no politician can ever manufacture. Now here is my question. When the greatest and most powerful empires in history collapse one by one, and their currencies turn into mere paper, which one holds its value? The answer to that question lies at the very heart of the story I'm going to tell you today. And this story is much more relevant than you might think. As someone who has followed the markets for decades, let me tell you this. People often say history won't repeat itself. They say, this time is different. However, the data, the charts, and thousands of years of economic history tell us the exact opposite. Today, we are going to look at that data together. I'm not going to explain this with complex equations like a finance professor. Instead, I'll explain it through the price of bread and your grocery basket. Because real knowledge is created and used not just by those who understand, but by those who take action. An unexpected lesson from the end of Rome. At the peak of the Roman Empire in 100 AD, a silver denarius consisted of about 90% silver. Visualize this. You have a heavy, pure, truly valuable coin in your hand. You can buy bread, fabric, or weapons with it. Merchants smile when they see this coin because they know exactly what's in it. Now, the empire is growing. You need to feed the armies, build new palaces, and protect the borders. The money runs out. What do? Simple. Reduce the silver content in the coins and mix in more copper. No one will notice, right? By 268 AD, that same denarius contained less than 5% silver. What was the other 95%? Just copper with a thin silver plating on top. It was a complete deception. Today, we call this inflation, the artificial expansion of the money supply. In Federal Reserve terminology, it's called monetary expansion or quantitative easing. The label changes, but the mechanism remains the same. So, what did gold do during this process? Gold remained gold. No emperor could mix even a tiny bit of copper into it. The Weimar Republic. History's wildest inflation. Experiment in 1919. Germany had lost World War I and was forced to pay astronomical war reparations under the Treaty of Versailles. The solution? Print money. Print more money. Print money uncontrollably. Let me give you a figure. In 1919, a loaf of bread cost 0.29 German marks. By November 1923, that same loaf of bread reached 200 billion marks. Let's read that number again. 200 billion marks for a single loaf of bread. At this point, people had to use wheelbarrows just to carry their cash. When you entered a restaurant and ordered a meal, they told you to pay up front because the price could double by the time you finished eating. Workers would take their morning wages and run to the market during their lunch break because the money would lose value by evening. This is a historical laboratory showing how an out-of-control money supply paralyzes a society. And what do you think happened to gold during this period? Those who held gold preserved their wealth. They survived not with the worthless Weimar mark, but with real purchasing power measured per ounce. 1971. And gold's hockey stick chart. There is a specific moment in history that determined the course of the modern monetary system. August 15, 1971. That night, U.S. President Richard Nixon went on television and told the world, "The American dollar is no longer pegged to gold." In short, if you hold dollars, you can no longer exchange them for gold. The Bretton Woods system collapsed. From that day on, the world transitioned completely to a fiat currency system. What does fiat mean? In Latin, it means "let it be done." It means a government assigns value to an ordinary piece of paper and says, this is money. The basis? Trust. And history has shown us repeatedly that it is very easy for governments to lose that trust. Before 1971, the price of gold had remained stable at around $35 per ounce for decades because that was a policy decision. After 1971, the free market took over. In 1980, it skyrocketed to $850. In the 2008 crisis, it crossed $1,000. During the 2020 pandemic, it surpassed $2,000. By 2024, it tested the $2,700 levels. When you pull this chart from the Federal Reserve's own database, Fred, look at the shape that emerges. A flat line until 1971, then a sharp break, followed by an increasingly steep, non-stop upward trend. That is the hockey stick chart. And it is no coincidence. It is the inevitable and unavoidable mathematical result of systematic money supply expansion. Data doesn't lie. Let's look at the Fed's own numbers. I'm not selling you my opinion. I'm showing you the data published by the Federal Reserve itself. Go to the Fred platform. Federal Reserve Economic Data. Type M2SL into the search bar. You'll see the chart of M2, the broad money supply of the U.S. since 1959. Pay attention to what happened in March 2020. The pandemic started, the Fed announced, we can print an infinite amount of money, and the chart literally shot up like a vertical cliff. In early 2020, M2 was approximately $15.4 trillion. By early 2022, it reached $21.7 trillion. In just 2 years, $6 trillion of new money was injected into the market. Now, a simple question. If a cake factory had 100 cakes yesterday, and today you claim to have 200 cakes without adding any new ingredients, how much substance is in each cake? Half as much. Money is the same. When more money is printed, each unit of money buys less. We call this inflation. And when you look at the CPI data released by the Bureau of Labor Statistics, you see that in 2022, inflation rose to 9.1%, the highest level since 1980. Is it surprising? No. It was the expected mathematical outcome, the real picture versus misleading headlines. In every period of collapse, in every inflation crisis, similar headlines appear in the media. The era of gold is over. This time is different. Central banks have everything under control. They said similar things in the Weimar Republic. Even in the late Roman period, pro-empire writers always wrote that the system was strong. When I read these headlines, I want to ask you one question. What does the person saying this stand to gain? How reliable is it when an institution within a financial system that keeps printing money says everything is fine? Let's look at the real data. According to research by the World Gold Council, gold has gained approximately 8,000 times its value in dollar terms over the last 50 years. In the same period, the dollar has declined to just 8% of its 1971 purchasing power. This means the $100 you put under your pillow in 1971 is worth only $8 in purchasing power today. But the gold you bought for $100 in 1971 is worth about $6,500 today. This isn't a prediction. This is historical fact. And this data tells you one thing systematically. There is a historical war between those who save fiat currency and those who save gold in a free market. And you now know very clearly which side is winning. The "this time is different" trap. There are 4 dangerous words in the world of finance. This time is different. Before every major financial crisis in history, these four words have been spoken. In the early 2000s dot-com bubble, they said, "Internet companies are outside traditional valuation rules." In 2008, they said, "Real estate prices never fall." In Weimar, Germany, they said, "The strong German economy can control inflation." So, what could actually be different this time? Right now, global public debt is over $300 trillion. According to data from the BIS, the Bank for International Settlements, this figure is over 350% of global GDP. Interest payments on U.S. federal debt have now surpassed the defense budget. There are historically two ways out of this debt spiral: either a deflationary collapse or eroding the debt through inflation. History tells us that governments almost always choose the second path. And when that second path is chosen, what does gold do? Looking at historical data, we can say with confidence, gold draws an even steeper hockey stick.
Gold is not just an investment. It's an insurance policy. People often frame gold as an investment and ask, does gold pay a dividend? Is there rental income? No, there isn't. But that is the wrong question. Gold is not a growth vehicle. It is a protection tool. You pay premiums to an insurance company every month, not because you expect your house to burn down, but so that if the system crashes, if a crisis hits, or if the currency loses value, that insurance policy keeps you alive. Academic research on portfolio diversification, specifically Ray Dalio's all-weather portfolio concept and Nobel laureate Harry Markowitz's modern portfolio theory, shows that holding assets with low correlation in a balanced portfolio dramatically reduces long-term risk. Gold is the only major asset class with a negative or low correlation to stocks and bonds. This means when the market crashes, gold usually rises. When the market booms, gold may lag behind. But you build your portfolio against both scenarios. In the long run, the winners are those who survive not just the bull market, but the bear market as well.
Personal responsibility. The system may be rigged, but there is a way out now. I need to be honest with you. Yes, the system is not fair. Yes, central banks tend to erode the savings of the middle class through inflation by printing money. Yes, the wealthy benefit from this process by accessing real assets, while wage earners lose their purchasing power. I'm not denying this. It was like this in Weimar, Germany. It was like this in the late Roman period. This is a historical script. But I also need to say this. Every minute you spend blaming the system is a minute you could have spent positioning yourself. Think of two neighbors during the Weimar inflation. The first spends every day reading imperial policies in the newspaper and getting angry. The second buys a small amount of gold, holds foreign currency, and insures himself against inflation. When the inflation passes, who is in a better position? You may not always have the power to change the system, but your own financial decisions are in your hands. This is what I always say. Financial freedom is not a simple right that a government owes you. It is a structure you must build yourself. The practical table. What gold did during crises. Let's move from theory to practice. Let's talk about data. During the 2008 global financial crisis, the S&P 500 fell 57% from its peak. What did gold do during the same period? From the beginning of 2008 to the end of 2009, it rose about 25%. During the 2020 pandemic, the S&P 500 crashed about 34% in March. Gold gained 25% that year and broke the record of the time in August 2020 at $2,067 per ounce. In the 1973 oil crisis, while the price of oil quadrupled in dollar terms, gold gained 73% that year. This is not a chain of coincidences. This is a systematic reflection of investors' search for a safe haven during times of crisis. Economists call this flight to safety. When people lose trust in the system, they turn to gold with an instinctive reflex that dates back centuries. And this reflex is a very rational behavior backed by data. Stocks represent your faith in a company's future. Bonds represent a government's debt. Gold, however, is not a promise of anything. It is its own weight, its own history, its own value. History is a warning. Action is a choice. The Roman Empire collapsed. The Weimar Republic sank with hyperinflation. The Zimbabwe dollar became a historical anomaly. The Venezuelan bolivar lost 99% of its value. In every single case, the vast majority of people at the time thought, "This won't happen to us." And in every single case, the few people who could see the system's trajectory preserved and even grew their wealth. Today, the M2 money supply in the US has expanded by over 40% compared to pre-2020 levels. The Fed's balance sheet went from around $4 trillion before the pandemic to nearly $9 trillion. These figures are on the Federal Reserve's own website, accessible to everyone. Real interest rates remained negative for years. Federal debt interest payments are surpassing the defense budget. These are not conspiracy theories. They are official data. And this data is systematically trying to tell you one thing. The purchasing power of currencies will continue to fall in the long term, while real assets will stand against this trend. Now, I want to ask you something. What will you do after acquiring this knowledge? Because knowledge alone will not save you. During the Weimar inflation, everyone saw the price of bread rising, but only a few people acted accordingly. History is written not with knowledge, but with action. Financial freedom is built not by every article you read, but by the accumulation of every decision you make. The system will never wait for you. Politicians will not make financial plans for you. Central banks will prioritize their own goals, not your savings. Accepting these facts can be difficult, but it is impossible to take action without accepting them. This 2,000-year historical lesson from Rome to Weimar tells you this. Empires come and go. Paper currencies usually lose value, and political promises often fail. But the wealth of individuals who have made their decision, positioned themselves financially, and reached for real assets continues to exist beyond all these turmoils. History is a warning. Action is your choice.